Hey everyone, good morning, DD10 here. Your no BS guide to the financial trenches. We just had our very first negative 1% day in the stock market for the first time in almost 2 full months. Since the 27th of March, the stock market dropped 1.2% last Friday, and the retail crowd is already panicking. There are a ton of critical things that you absolutely need to watch out for this week if you want to protect your capital. But if you actually watched my last Sunday video, I openly told you that I was starting a massive swing position in MRAM. To be completely honest with you guys, I expected this position to take a little bit longer to play out than it actually did. However, we were up a staggering 160% on this position within just a single week of holding the shares. MRAM's market cap went from $400 million to well over $1 billion in a matter of days. I closed that position out completely, banking a clean 160% gain on MRAM and locked in that cold cash today. I am going to give you a complete step-by-step blueprint here as to how to tackle this volatile market going forward. This is the raw data that you need to watch out for this week and exactly how to take advantage of it from a trading perspective. Listen, we are coming up on a historically bearish time frame for equities, and the average retail investor has no idea from May to October in midterm election years. The stock market tends to see a significant multi-month correction. The historical average for this specific downside move is minus 10 to 12% across the major indices. However, I want you guys to recognize something very important about the current year we are living in right now. There are absolutely no historical years ending in the number 6. Included in that specific ugly downside data, years like 1986 as well as 2006. Those specific years ending in 6 were actually incredibly positive for the market. And obviously right now in 2026, we have a unique calendar year ending in the number 6 that is admittedly a very small historical sample size. But you still need to know that midterm election years can be brutal. Now, although we have a brand new Fed chair that is supposed to start running the central bank soon, the timeline is messy. The Federal Reserve officially named Jerome Powell as chair pro tempore until Kevin Warsh is officially sworn in. And there is no concrete date for Warsh being sworn into office yet. Although I believe he was already confirmed by Congress, so the official swearing-in date has not been set in stone yet by the administration in Washington, and Powell will remain basically the de facto Fed chair running the show until we have that official ceremony completed. But I shared with you guys before that we also tend to see a market pullback during the first few months of a new Fed chair. The market historically loves to test the new Fed chair to see exactly how they handle sudden macroeconomic volatility. There was also a high-profile economic summit between China and the United States government last week, and China publicly stated that it reached a tentative agreement with the U.S. on certain tariff reductions and trade cooperation. They did this by committing to buy a significant number of commercial airplanes from American aerospace companies. But they also explicitly stated that even though the U.S. allowed them to buy high-end H200 chips from NVIDIA, they won't buy them. They openly claim to the press that they simply do not need those advanced chips for their current domestic technology infrastructure. I honestly do not know if that is just political grandstanding or what is actually happening behind closed doors with semiconductors. And speaking of NVIDIA, we do have the highly anticipated NVIDIA earnings report on Wednesday right after the closing bell. Now, I fully believe that they are going to beat earnings expectations and they are going to beat revenue estimates easily. It will likely be another record-breaking financial quarter for them. But obviously everyone is going to be focusing strictly on guidance. We also have the massive, highly anticipated SpaceX IPO coming down the line, but that major catalyst happens later next month. Now, in terms of how to actively trade this specific tech environment, I told you guys about using the 9 and 21 EMA street strategy. You want to apply the 9 and 21 exponential moving averages directly to the hot AI build-out infrastructure stocks. And I previously gave you a short list of some high-quality AI build-out stocks to keep on your radar. However, I have a complete updated list for you of all of the individual stocks that I am currently tracking from an AI perspective. You can get that whole list right now if you just click the specific link in the description below this video. I will send you the entire PDF document absolutely free of charge because I hate how gurus gatekeep information. So make sure you click that link and I will send you the PDF of the complete list of AI build-out stocks immediately. But as I said before, you can actively swing trade these high momentum names directly from the 9 and 21 EMA lines. And if you actually followed that specific technical tip last week, look at what happened to AOI, which is a key photonic stock. You can see clearly on the daily chart that from the 9 and 21 EMA bounce just last week, it rocketed up 53%. The exact same profitable scenario happened for Light, which is the ticker symbol for Lumentum Holdings. If you followed that tip from the last video, Lumentum Holdings was up a massive 21% in a flash. And the list goes on and on with identical technical setups working perfectly across the board. Coherent, which is another major photonic infrastructure stock, did the exact same technical setup, jumping aggressively directly from that key 9 and 21 EMA support level on the chart. And as I said before, you want to aggressively take advantage of this macro trend until the trend is no more. I do not care what the broader historical statistics say about midterm election years being seasonally bearish for stocks. A lot of these specific smaller infrastructure stocks are not even listed in the S&P 500 or the Nasdaq index, but as I said, I think that the current market cycle is focusing heavily on physical photonics and data center technology. Nebius also made a brand new all-time high again last week, bouncing perfectly off the 9 and 21 EMA line. Now, if this specific technical trend breaks on the daily chart, then yes, you stop doing this trading strategy immediately, because the trend is always your friend until the absolute end of the cycle. But when this trend officially breaks, then you will know that is the exact time to let your foot off the gas on this strategy. With the AI build-out stocks, we might be also witnessing a quiet capital rotation into the software sector, because IGV, which is the major tech software ETF, is up a quiet 25% since the 10th of April. And I did a whole extensive write-up on ServiceNow as well, sharing my complete fundamental thesis for long-term investment, looking closely at their underlying free cash flows using the advanced AlphaScope software platform, obviously looking at their cash from operations, looking at their EBITDA growth, and looking closely at their revenue expansion. These fundamental charts all look like textbook, perfectly linear graphs moving up and to the right. It almost looks too good to be true for a public software enterprise company, but ServiceNow is an incredibly high-quality company that is growing by all of the important metrics you want to see. They are growing their actual business at a very consistent, predictable, and highly profitable pace. Shout out to AlphaScope for making those fundamental financial numbers so easy to analyze at a single glance. Signups for the AlphaScope platform are now open to the public at the introductory rate of $19 a month. It drops down to just $16 and change if you choose to bill the platform annually. But at some point in the near future, the prices will be going up significantly for new users, so make sure that you lock in that low rate today if you want to take advantage of the best fundamental tool in the market. But could we be seeing a major rotation into software as Microsoft also looks like it wants to break out higher? Although it did drop a little bit after hours on Friday when it was announced that Bill Gates had sold his remaining position. To me personally, that specific mainstream media headline is a total non-issue for long-term investors. Bill Gates sold the vast majority of his core Microsoft stock a long time ago to fund his foundation. And he actually missed the historic opportunity to become the world's first trillionaire because of selling too early. He sold a massive chunk of his shares way before this historic AI pump to the mid-500s. So for me, Bill Gates selling his last tiny bit of shares is something I do not care about at all. He already missed this entire massive AI pump on Microsoft and sold way too early in the grand scheme of the macro economy. Missed out completely on a historic chance to become the first multi-trillionaire on the planet. And if we do get a deeper market dip across the board here, that is going to be an absolute gift for buyers because the S&P 500 is currently on a massive, historic 7-week winning streak. And historically, 52 weeks after a winning streak like this, the S&P 500 has never been in the red. Now, I am always 100% honest with you guys on this channel, and I will openly tell you when I do not know something, but is the S&P 500 going to see a massive standard market correction right here in May? I do not think that we are going to get a standard 10% correction here just because retail traders feel nervous, but I do think that the market will likely be testing the brand new Federal Reserve leadership under Warsh, especially right after the first Fed meeting or two under the brand new central bank regime. So I do think that we will see a real correction play out somewhere later. This calendar year, I just do not know that the major correction starts right now just because we had a single red candle last Friday. But if we do get a correction, that is 100% a viable buying opportunity for serious long-term investors. I think that the global corporate AI build-out phase is still fairly early in the overall macro cycle. I think that there is still much more market euphoria to go before the music stops completely on this bubble. And I think that the market will likely see a massive rotation into lagging sectors like enterprise software before there is a major structural bear market or a major systemic correction somewhere in the year 2027. I do not think that the final market top happens without these high-margin software stocks also flying to the moon. Now, crude oil is still hovering at incredibly stubborn levels well above $101 a barrel. Obviously, the ongoing geopolitical issues and military actions around the Strait of Hormuz are not solved whatsoever. President Trump is set to speak with Israeli Prime Minister Benjamin Netanyahu today regarding military actions against Iran. Regional intelligence sources indicate that the Iranians believe they can drag out this stalemate for at least 2 weeks. Tehran is deliberately pursuing a strategy of deception and delay to buy time and complicate a potential return to war. They are aiming for the upcoming World Cup and America's 250th anniversary to work as a geopolitical backstop. Efforts toward a diplomatic solution have completely failed because Iran refuses to make the necessary nuclear concessions. President Trump indicated he threw away their peace response because he didn't even like the very first sentence of the text. He is demanding a real 20-year guarantee with absolute nuclear restrictions or diplomacy is totally dead. Meanwhile, the Iranians are accusing the United States of confusion, pointing out past attacks on their facilities. The U.S. military has serious resolve with the USS Gerald R. Ford carrier strike group returning from a massive deployment. But strategic analysts are rightly pointing out that the United States is becoming heavily overextended across the globe. We are stretched thin in Europe with Ukraine, in the Middle East with Iran, and now there are fears regarding China and Taiwan. A recent strategic war game revealed the United States would likely run out of precision guided missiles within a single week. China currently dominates militarily in the Indo-Pacific region in almost every single platform except for submarines. And top advisors fear that Xi Jinping may move to invade Taiwan within the next 5 years to secure geopolitical equality. They want Taiwan because of its technological dominance, as they manufacture the most advanced AI semiconductor chips in the world. Whoever owns that physical manufacturing capability in Taiwan is ultimately going to own the future of artificial intelligence development. With peace talks stalling, the US and Israel are reportedly preparing to resume combat operations against Iran as soon as this week. The plan is to execute a combined military campaign to take out the IRGC destroy weapon systems and flatten their remaining nuclear elements. They are going to target every single revenue source to put the Iranian regime on a path to complete economic collapse. This severe global tension means the market spending months with crude oil hovering around $100 is a massive warning sign. To me, an economic recession is almost guaranteed at some point because of this severe ongoing energy tax on businesses, and we are already starting to see the core CPI inflation data come in at hot levels we haven't seen since the pandemic. CPI came in hot at 3.8%, which represents the highest level we have seen since May of 2023. Core inflation also rose up to 2.8%, coming in well above Wall Street consensus expectations of 2.7%. And the absolute worst macroeconomic numbers of all were found inside the recent PPI Producer Price Index report. The Producer Price Index surged ahead to a staggering 6%, coming in way above expectations of 4.9%. We have not seen raw production costs rising at these prices since January of the year 2023. Core PPI came in at a hot 5.2%. Coming in way above consensus expectations of 4.3%. So the longer that this hot inflation sustains in the real economy, obviously the Fed is not going to cut interest rates. I do not think that this specific Fed is going to actively raise interest rates back up either, but the realistic chances of a rate hike are higher than a rate cut for sure because of this sticky data. And I think that the economic chickens will ultimately come home to roost on Wall Street, possibly in 2027. So I do believe that there is still more market euphoria left in the tank for the rest of 2026. And it is our immediate job to try to take advantage of that trading opportunity while the liquidity lasts. But I do think that the entire macro cycle will end very badly at some point in the year 2027. So you are really going to have to play this current market environment very tightly with strict risk management. You are going to have to know exactly when to take profits and when to put your foot on the gas. And if you want real-time access to all of my long-term analysis as well as my active swing trades, join us. Trades like my recent profitable MRAM position as well as the underlying data center stocks are all shared transparently. The sign-up link is available right in the description below this video. Go get yourself access to AlphaScope today before the introductory price goes away forever. It is the absolute best fundamental analysis tool, in my opinion, for finding undervalued equities. It will do absolute wonders for your portfolio and your structural ability to pick winning stocks. It is only $19 a month or $16 and change if you sign up for the full year. And make sure to grab that free PDF detailing all of the target stocks of the corporate AI build-out. I look forward to seeing you guys inside our community. And in the next video, indicators do not lie. Data does not deceive. Stay safe out there on the charts. Traders,